Good morning, everyone. My name is John Cornwell, and I'm the Director of Practice Development here at Plunkett Cooney. It's my pleasure to serve as coordinator for today's webinar, which kicks off a three-part series about what to do when the IRS comes knocking. Today's webinar is part one, and we will focus on the IRS collection process and the two most common collection alternatives that the agency makes available to taxpayers. Fortunately for us, we have the right person joining us today. Joe Peterson will guide us through this complex topic, and Joe is an attorney in the Plunkett Cooney Tax Law Practice Group, and I'll formally introduce him in just a minute. Now, before I get started, I'd like to take just a few moments to provide you with some background about Joe and our law firm. For those that don't know, Plunkett Cooney is based in Southeast Michigan and is one of the Midwest's oldest and largest law firms with approximately 120 attorneys. We have offices in 7 Michigan cities, as well as in Chicago, Illinois, Indianapolis, Indiana, and Columbus, Ohio. The members of Plunkett Cooney's tax law practice provide an array of services from business tax controversy and tax planning to personal tax controversy and issues related to state and local taxes, including commercial property tax law and appeals. Now for just a little bit more information about today's presenter. Let me introduce you to Joe Peterson, who for a decade now has worked with businesses and individuals to address their tax law needs. His expertise includes dealing with collection actions brought by the IRS against individual taxpayers and businesses. Joe routinely advises and represents clients in virtually all facets of tax law, including personal and business tax controversies. His efforts have helped clients be a bit more at ease. And I could say without hyperbole that he's helped them save millions of dollars in tax liability along the way. So he's definitely a good guy to know. Now, just a couple of housekeeping notes about today's program. For the Q&A portion of our webinar, we're going to use our questions window on your GoToWebinar navigation display. Please take a moment now to locate the window and feel free to enter questions as they occur to you during the program. At the end of the presentation, we'll answer as many questions as time permits. However, I always add one caveat, which is please ask questions of a general nature, discussing your specifics or anything about your ongoing issues is best done privately, as we are sure you will agree. And finally, I want to mention that today's session is being recorded, and that recording will be available on the event page of Plunkett Cooney's website, which is located at plunkettcooney.com. Thanks again for attending today's webinar. Now let's get things started. Joe, you're up. Please take things away.
Good morning, and thank you for attending today's event. My name is Joe Peterson. I am the Tax Practice Group leader here at Plunkett Cooney. Today's webinar will explore the IRS, specifically the IRS collection process, and a couple of collection alternatives that are available to taxpayers who want to resolve tax balances with the IRS. So to start with, I thought it would be a good time to talk more about who the IRS is and the collection process. So the IRS is the Internal Revenue Service. They are the agency that works with the Department of Treasury and is tasked with the collection of taxes and the administration of the tax return process. So if the IRS contacts a taxpayer for any particular reason related to a tax balance, there is a very strict and predictable pattern that the IRS typically follows as part of that collection process. So the first thing that the collection process entails, or the first thing that the IRS does, is it looks to see that a tax return was filed by a taxpayer. Provided that a tax return was filed and a balance was posted, the IRS will check to see if the taxpayer paid the balance along with filing the tax return. Now, an important thing to note here for taxpayers is that the IRS does not need to have a return to post a balance for that tax year. The IRS can do what is called substitute for return, which is if the IRS waits long enough past the date when the return was due and the taxpayer has not filed the return, the IRS will file a substitute return, which takes the average gross income for that taxpayer from returns that were filed previously and posts that to the taxpayer's transcripts and then assesses tax based on that tax return. So that's a common myth that many taxpayers encounter, which is that as long as they don't file a tax return, they can't get in trouble with the IRS, and that is simply not true. Once the IRS has a tax balance that they want to collect, the first thing that they do is they assess that balance to the taxpayer. To assess the balance, what that simply means is that the IRS will begin making contact with you, either through phone calls or through notices. Now, by design, go back a slide if you would please. By design, the notices that the IRS sends are, designed to be a little scary. They look a little intimidating, but that's simply not the case. They are simply there to inform you that you do have a tax balance and to implore you to take that tax balance seriously, to reach out to the IRS and to take care of it. So they will assess the balance, and then they will begin what's called enforced collection, meaning that there will be various members of the IRS that are assigned to collect that balance. You'll see an uptick in the amount of notices that you receive. The phone calls will increase and so on. And the goal is to push that tax balance towards a resolution. And a resolution can take many forms. It might be that as a taxpayer, you didn't know you had a balance. And so when the IRS reaches out to you to say, hey, you have a tax balance for 2023, for example, the taxpayer writes the IRS a check for the outstanding tax balance, and that is the end of the matter. But oftentimes, that's not what happens, simply because taxpayers often have various other things or circumstances that are impacting their financial ability to take care of a tax balance just in completely in that manner. So when that occurs, there are other resolution options available. The two most common collection alternatives that we're going to discuss today are an installment agreement, or IA, short at the IRS, an offer in compromise, or OIC, and what is called currently uncollectible status. So we talked a bit briefly here about these particular items. We're going to talk about them in more detail. So the assessment process basically starts with the IRS determining how much you owe. And that, again, can either be from the tax return itself or by looking at taxes that you failed to report. So that's an important feature, too, of the assessment process. If you file a tax return and the IRS reviews it, and perhaps you forgot to include a W-2 from some side work that you did that's outside of your normal job, well, the IRS is going to receive that documentation as part of its tax year process. And it will assess additional tax as necessary to taxpayers who, for one reason or another, fail to appropriately capture all income on their tax return. And then they will do this both ways as well. So it's not simply going to be the type of thing that happens purely when you have a tax balance. The IRS will also issue a refund if appropriate too. But the goal here is that the IRS wants to make sure that the tax return and the reporting done by the taxpayer for any given tax calendar year is complete and accurate. So that's the first step in the process. The IRS must get that part correct because once they assess the taxes, it becomes more difficult over time to go back and correct those things. And it also starts off a time period that the IRS has to collect that balance. And we'll discuss that more further on in this webinar. Once the IRS assesses taxes, the taxpayer will begin to get notice and demand notices. These are simply bills that the IRS sends in the mail to you. So a notice will formally request payment. It will say what the payment is for. It will say what the balance is. It will indicate whether there are any penalties and interest, which is likely the case if you have failed to make timely payment of your taxes when they're due. And they will send those to you at the mailing address that is listed at the top of your tax return. So this is important as well. You have an obligation as a taxpayer to make sure that you update your mailing address as it changes. So if you move, or perhaps you rent a property and then you change your rental address, or perhaps you get a P.O. box and the P.O. box goes away, it is important that the taxpayer keep the IRS up to date on their current mailing address. Why? Well, if you don't do that as a taxpayer, and the IRS attempts to get a hold of you based upon the address that they have on file from you from either your tax returns or on an update that you've made on irs.gov, it is not going to be the IRS's responsibility if you fail to get those notices and take appropriate action. So the notice and demand process will put you on notice, but it's also incumbent upon you as a taxpayer to make sure that you have appropriate information on file at the IRS so they can contact you if they need to. Once notice and demand has been issued by way of these notices, the IRS typically will have a 10 to 21 day waiting period to give the taxpayer an appropriate amount of time to review and think through the assessment, determine if they feel as though it was correct, because it is possible that the IRS is missing something or that they've miscomputed the taxes due for one reason or another, or perhaps even payment's been sent in and it just hasn't hit the IRS system yet, and so the notice is no longer valid. Either way, before the IRS moves on to the final step in the process, they will give the taxpayer an appropriate amount of time to address any outstanding tax balances. Once the IRS gets past the waiting period, they will move into the phase called enforced collection. Now, enforced collection is exactly what it sounds like. A revenue officer often will be assigned to a taxpayer's case. Perhaps it might be an automated collection services individual, but either way, it will be a member of IRS staff who will reach out personally to begin to make contact with the IRS, with the taxpayer, to really drive the collection process. The IRS will presume that you are not interested in just dealing with it on your own based upon the notices that you've received, and will take very active steps to try to contact you to get your attention to take care of your tax balance. The enforced collection process has several different features that it would include as part of the process itself. The first is that the IRS will often place federal tax liens against taxpayers who own real estate. So if you own your home and you have a tax balance above a certain threshold, the IRS can, doesn't have to, but it can place a federal tax lien against that property. Now, these federal tax liens can take a couple of different forms. They can be federal tax liens that are not recorded with the local municipality. In other words, they won't necessarily show up on your credit report. They won't necessarily show up in public record, but they are very much still there, and the IRS will send you notice to let you know that that's the case, which means that if you were to try to sell your home once this federal tax lien is in place, you won't be able to do so unless you satisfy that tax lien first. The other kind is a bit more aggressive, and the IRS is doing this type of federal tax lien more commonly these days, which is to say that they will file the tax lien with the local municipality so that it will show up in public records, and you will also see it on your credit report. And this is important because it acts as kind of a double whammy for taxpayers. Not only do you have an outstanding tax balance, which can be, rather large depending upon your particular tax circumstances, but it will also reduce your credit score, which will impact your ability to borrow, and it might even impact employment prospects depending on what type of industry or line of work you pursue. The second is that the IRS can levy your assets. So assets that can be levied by the IRS primarily include bank accounts and investments held by the taxpayer, including 401ks or pension funds or what have you. The IRS has the ability to file appropriate paperwork with your bank to basically seize the assets that are in your bank account. If you're a business, they can go as far as to seize accounts receivable as well, or business assets, including capital assets that are owned by the business if necessary. There's an important note with this. The IRS wants to not inhibit your ability to pay. So, they want to make sure that if they do levy assets and then seize them, that they're not putting you out of business. They're not making you a ward of the state necessarily. But that being said, if they have the ability to find and locate assets, which they're very good at, they will levy assets if you ignore them long enough. And then in extreme cases, the IRS can also seize and sell property. This primarily occurs where a taxpayer owns investment or business property. the IRS can seize that property. In other words, take title possession of it and sell that property to satisfy outstanding tax balances. And then the final thing that the IRS can do is for taxpayers with large tax debts, they can refer the taxpayers' delinquent tax balances to the State Department of the United States and certify them as being delinquent. When they do this, it can have the effect that the State Department will either deny any passport application that is subsequently submitted by the taxpayer, or they might suspend a passport for a taxpayer for whom a passport has already been issued. This could be a rather big deal, particularly if you are a professional who travels quite a bit internationally for business. You can find yourself stuck and in need of really addressing that tax balance. Now, what's important to note here is that the IRS is not going to leave you stranded. So this is not the type of thing where you have a tax balance and you travel internationally, and then while you're gone, provided it's a reasonable time frame trip, the IRS revokes your passport and you're stranded. That's certainly not going to be the case here, but suffice it to say, the IRS can take action against your passport if you do not address your tax balance. So if you're a taxpayer and you begin to get phone calls or notices, or you know in advance that you have a tax balance, what should you do? Well, as a tax practitioner, what I tell clients to do primarily is, first and foremost, don't ignore the IRS. If you know you have a tax balance, you don't need to wait for them to call you before you address that tax balance. And oftentimes, doing this will lead to better outcomes for you in terms of collection resolution. So with that being said, an important thing that clients or taxpayers need to do is, if you get mail from the IRS, open your mail. It is surprising how often I talk to a taxpayer who says, "Hey, Joe, I know I've got an issue with the IRS. They've been reaching out to me, and I've gotten mail from them as well, but I don't want to open it." Well, not opening your mail leaves you in the dark as to what is happening at the IRS. The IRS is very process-driven, so they're going to tell you in advance what the problem is and what they're considering doing, and they're going to do that through these notices. So if you don't open your mail and you're not keeping up to speed on what the IRS is communicating to you, then it is very difficult to know what to do to address it, other than to just call the IRS and pay the balance in full. And there are certain deadlines that must be considered, and once they're missed, they're gone forever. So again, the most important thing that you can do initially at the very beginning, if you know that you have a tax problem with the IRS, is to open your mail. The second thing is to file any missing returns that have not been filed as soon as possible. So if right now the 2024 tax returns would have been due back on April 15th unless you filed an extension. If you're missing your 2024 or any returns prior to that, and you know you have a tax balance, it's important to file any of those returns as soon as possible. Twin to that is, it's also important, if you're a self-employed individual, that you make any estimated tax payments on time as well. So the reason for both of these is that the IRS requires that any taxpayer who calls the IRS to come up with a collection resolution, they must be filing and payment compliant before the IRS will talk to them about resolving their tax debt. And the reason for this is that the IRS doesn't want to create a situation where a taxpayer goes through the entire process of setting up a payment plan or resolving their tax balances, only to immediately post a new tax balance that wasn't considered as part of that process. The IRS wants to give taxpayers a true fresh start when they negotiate some form of settlement for their tax balances. And that can't occur if there are tax returns that are missing, or if there are payments that haven't posted, or what have you. So other than opening your mail, these other two items are the single most important things that you can do. You must be filing compliant, and you must make your tax payments, provided that you can, on time and as completely as you can. The other thing that you can do is to contact the IRS. Calling the IRS is not a bad thing to do. Hiring a tax practitioner is even better because then we can call on your behalf. But calling the IRS to request time to let them know that you have received their notices, that you know that you have a tax balance, and that you're taking steps to address that tax balance, even if you're not in a position to be able to make payments right away, is important, because letting the IRS know just that you aren't ignoring them and that you're taking your tax balances seriously will go a long way with the IRS towards their willingness to work with you in terms of providing more time or offering certain collection alternatives to you that wouldn't potentially be available to you if the IRS feels that you are ignoring them. Or to go a step further, it might head off certain adverse things that the IRS might do, like placing liens or seizing property that the IRS does when it feels that a taxpayer is not taking their tax obligations seriously. So contacting the IRS is not a bad thing. And then my final point here really kind of highlights what I just said about ignoring tax balances. It only leads to escalating penalties and interest. And the IRS will only take stronger and more aggressive actions for taxpayers that they feel are ignoring them. So it is never a good idea. Opening mail, getting compliant, and making payments on time, and then contacting the IRS are always the proper steps to take at the beginning of any tax issues with the IRS. So how long does the IRS have to collect taxes? Well, the IRS does not have an unlimited amount of time to collect tax balances. From the date that a tax balance is assessed for a certain calendar year or tax year, the IRS has 10 years to collect that tax balance. Once the last day of the 10th year elapses, that balance is permanently gone. The collection period is called the collection statute expiration date, or the CSED. And again, that's a 10-year period from the date that the tax is assessed. So again, simply not having a tax assessment, it won't allow the statute to run. And that cuts both ways. So if the balance is assessed and you hit the 10th year, then the balance becomes no longer collectible. But on the other hand, if you fail to file your tax return and the balance is never assessed, well, the IRS has an unlimited amount of time to collect that tax balance if you post one. So, this is what a common misconception from many taxpayers. If a taxpayer thinks or believes that it will have a tax balance due to the IRS, oftentimes they just won't file the return. That could be a major issue because, again, what you'll run into is that the IRS simply can't assess the tax balance, and then sometime down the road, you'll end up filing that return. You'll have to, and you'll have to deal with it at that point in time. So, again, you can't outrun the IRS with this stuff. You have to file your tax return, and you have to deal with it. But it's important to know that the IRS does have 10 years to collect that tax once the assessment is made. There are several events that can cause that 10-year collection period to toll or to stop counting towards the 10-year period. The first is if you seek certain collection alternatives. So if you were to file an offer in compromise, which we'll talk about later, if you declare bankruptcy, if you sue the IRS in any capacity, that will effectively pause the 10-year collection statute. So it will add time to the back end of that 10 years. So the important point to take away from this is that 10-year period is not an absolute value. It does, it can be paused if you as a taxpayer take certain steps to resolve your tax debt. And so that's why it's important to hire a tax practitioner in many cases, so that you can be thoughtful about the approach you take to address your tax balances in a way that doesn't add time on to the amount of time the IRS has to collect that balance. If the CSED is not stopped or told for any reason, the IRS has 10 years, and they can only extend that 10 years if you provide them with written permission. So it really is a hard and fast deadline that the IRS has to collect the tax balance. The collection statute, the amount of time, this 10-year period that we've been discussing, can be difficult to determine at times for many taxpayers. Because even though you get a notice, it's hard to know what the first notice was when you get the initial assessment. But there are ways to figure that out. And the three key ways to do that are to call the IRS and ask them directly. If you call the IRS, they will be able to tell you for any given tax year what the collection statute will be, when that 10-year period began and when it's likely to end. If you do that, it's important to note that every tax period has its own collection statute. Why is that? Well, if you filed a tax return in 2023, it's going to have and you have an assessment for that tax balance, it's going to have a shorter collection period by a whole year, most likely, than any balance that you post in 2024. So don't assume that just because you have a 10-year collection statute for one tax balance that it extends to all of them. It is very likely that each of them have a different collection statute, and in many cases they're going to be exactly 1 year apart, going back to the oldest. The second way is to request a tax account transcript from the IRS, or by pulling a tax account transcript from irs.gov. Either way will allow you to view the collection statutes as well as the tax balances for any given tax year. And then the final way is to consult with a tax professional like myself. We have tax software, we have knowledge and the ability to pull information either from the IRS or from other sources that will give us a very clear and easy to understand indication of what the collection statutes are for any given tax balance for any given tax year. So now that we've talked through the collection process, I want to take a moment now to talk through from a high level what the most common collection alternatives are. And in today's webinar, for time's sake, we're going to focus on the two most common. But that being said, I thought it would be a good opportunity to walk through sort of the universe of the most common collection alternatives that are employed by tax practitioners and by the IRS to settle tax debts. Those are installment agreements, offers in compromise, currently on collectible status, bankruptcy, penalty abatements, passport denial or reinstatement, lien release or subordination, and innocent spouse relief. So the first and the most common type of collection resolution that a practitioner like myself or that the IRS employs when it deals with taxpayers is an installment agreement. An installment agreement is simply an agreement between the IRS or many states for that matter and a taxpayer that allows the taxpayer to pay down their tax balance in monthly installment payments. The installment agreement will have an outstanding balance, it will have a monthly payment amount, and it will have a set amount of time that the taxpayer will make payments to resolve the outstanding debt. Now, those are the only things that these installment agreements typically have in common. There are many different flavors of installment agreements. We're going to talk about those in more detail later on in this webinar, but it is instructive to think of installment agreements very similar to a revolving balance that you might have for a credit card or car payment or something similar to that. You have a balance, you have a monthly payment, you pay it over time. At a certain period of time, you don't make any more payments because you've paid off the entire balance. It is no different with an installment agreement. And because the installment agreement allows a taxpayer to pay the balance over time, and it typically doesn't involve any forgiveness of the tax balance, it is far and away the most easy way to resolve a tax debt with the IRS. So now that we've covered the high-level view of these tax or the installment agreement, the next part is to discuss in more detail what they look like in terms of the different flavors that are offered by the IRS. The two simplest versions of an installment agreement are a short-term installment agreement and a guaranteed installment agreement. A short-term installment agreement is an option for a taxpayer who files a tax return but just doesn't have the capital available on hand to make a full payment along with their tax return. It's an installment agreement that allows the taxpayer to spread out any taxes due over 6 equal monthly payments, and it can be set up by calling the IRS over the phone. There's really nothing else to do. You call the IRS, you say, listen, I have a tax balance for a brand new return I just filed. I don't have the capital to pay it in full. Can we stretch it out? And the IRS will do it with with no requirement for financial information or disclosure or anything like that. The second most common is called a guaranteed installment agreement. And this is for taxpayers who owe less than $10,000, and it allows the taxpayer to pay the full amount owed within 3 years. So to differentiate it from a short-term installment agreement, the short-term installment agreement does not have a maximum tax balance, but you are required to pay it off over 6 months. A guaranteed has a maximum amount, which is $10,000, but it will allow the taxpayer to stretch those payments out over 3 years. Similar to a short-term installment agreement, a guaranteed installment agreement requires very little, if any, information to be provided to the IRS, and is generally granted provided that, again, your balance is less than $10,000 and you're able to full pay the amount over 3 years. A streamlined installment agreement is a slightly different version from the first two, in that it increases the amount that a taxpayer can owe in terms of their tax balances to $50,000, and provided that the taxpayer has no previous installment agreement over the last 5 years, allows the taxpayer to pay off their tax balance over the length of the remaining collection statute. So, if you do this early in the tax collection cycle, you're often going to have much more time. So it can be stretched out as long as 9 or 10 years, because that's the full collection statute. So the point behind a streamlined installment agreement is it allows you to have a much bigger balance. So remember, $10,000 was the amount for the guaranteed. This takes it to $50,000, and then it allows you to pay it off over a much greater period of time. So you can extend far past the 3 years. So for many taxpayers, this is an attractive option because it will allow you to get a much smaller payment often than what you would have, particularly if you have a large balance, if you were to use a streamlined or a guaranteed installment agreement, or a guaranteed or a simple installment agreement. Businesses are slightly different. Their tax threshold is $25,000, and they have to agree to pay it off over 24 months. So individuals have the life of the collection statute. Businesses have to do it within 24 months. As with the other two we previously discussed, this installment agreement type does not require any financial information and can typically be established simply by calling the IRS over the phone. Before we move on to the final installment agreement types, I wanted to take a moment to talk a little bit about the process the IRS uses to collect financial information from taxpayers. And this is important not just for installment agreements, but for offers and compromise that we will discuss later on in this webinar. The IRS uses a collection information statement, or CIS, to gather a summary of the financial health of a taxpayer and to assess that taxpayer's ability to make payments. The collection information statement is a detailed statement of income from all sources, and it allows the taxpayer to deduct from that income allowable expenses, many of which are national standards employed by the IRS for things like food or personal care products or services or car payments or what have you. The IRS uses the collection information statement to determine what assets are available and to really hone in on what the remaining monthly income is after expenses are deducted from income that can be used to make a potential monthly payment to settle tax liabilities. So it's a very useful piece of or form that the IRS collects, and they will often require, along with just filling out the form, financial statements to substantiate what the taxpayer is saying. So that may take the form of bank accounts, pay stubs, car payments, or what have you, so that the IRS gets a very clear picture of exactly where the taxpayer is at that particular moment in time. So there's two additional installment agreement types we're going to talk about. The first is just a regular garden variety installment agreement. This one is different than the previous three that we talked about in that the IRS is going to require that a collection information statement be submitted along with the request for the installment agreement. This is for taxpayers who can't meet the very specific requirements that are characterized as part of the first three that we talked about. So, if you need a longer period of time to pay off the balance, or your balance is over a certain threshold, oftentimes a regular installment agreement is going to be where you end up landing when you are resolving your tax debt with the IRS. The IRS will require this collection information statement, and then the goal will be that the resulting monthly payment, or the taxpayer's ability to make a monthly payment, must be sufficient to fully pay the tax balance before the collection statute. So what's important to know about this installment agreement type, and this is true for all of them for that matter, is that the IRS is going to right size, in many cases, the installment agreement based upon this collection information statement to what the taxpayer is able to afford. If the circumstances for the taxpayer were to ever get worse, so their financial health got worse because of the loss of a job or some other circumstance, you can always go back to the IRS and ask them to adjust the payment downwards to reflect your new financial health. The IRS, though, is not going to turn around and increase the installment agreement if your circumstances were to get better. So this is a kind of a neat feature in terms of establishing installment agreements. If you know that you are at a place in your financial life where perhaps your circumstances are worse than they will be in the future, you can set yourself up in such a way that you're making a payment that will become much more affordable in the future when your circumstances get better. So it's something to think about, but it's also something to know that you don't need to worry about the IRS coming back and readjusting it upwards if things were to get better for you. And then the final type that we will talk about, and then a very important type of installment agreement, is called a partial pay installment agreement, or PPAIA for short. This installment agreement type is sort of an intermediary between a regular installment agreement and an offer in compromise that we will discuss later. It allows a taxpayer to make a payment towards their tax balance that will not fully pay the tax balance in full by the time the collection statute expires. So this is an important distinguishing feature between a partial pay installment agreement and any of the other installment agreements that we've discussed thus far. The previous installment agreements that we've discussed will all pay the balance off prior to the collection statute expiration date, or the CSED date. A partial pay installment agreement will not do that. And in doing so, the IRS is going to agree, should they allow you to establish a partial pay installment agreement, to forgive whatever tax balance is remaining at the conclusion of the collection statute. So this is an important mechanism for many taxpayers who really are income poor, to be able to establish an installment agreement to address their tax balance while kind of getting some relief at the back end where the IRS forgives that balance. I like to bring this up with taxpayers because this is not often a misunderstood option available to taxpayers. Many taxpayers feel like if they have a large tax balance and they just simply can't pay it because they can barely make ends meet, that the best option is simply to ignore the IRS and just deal with the calls and deal with the notices. Well, that's not the case. For a taxpayer who has those circumstances, you can call the IRS and say, look, I just have very little money available to make this payment, and the IRS will literally right size it to what you're able to pay. I've seen taxpayers who have very large 5- and 6-figure balances make very small relative payments towards that tax balance. The key here to know is that the IRS is very interested in collecting whatever money they can towards the tax balance. That's their primary concern. And their twin concern to go along with that is that they don't want to put taxpayers in such bad condition after making tax payments on a monthly basis that they then have to turn to the federal government or the state for support. So, the IRS is really going to work with you as a taxpayer to find a solution that allows you to make payments towards your tax balances that's not going to, completely bankrupt you and put you in bad shape. That's important to know. And this partial pay installment agreement is one of the cheap vehicles that the IRS uses to accomplish that. So if the IRS were to grant you a partial pay installment agreement that is less than the amount that would be needed to fully pay the tax obligation by the end of the collection statute, one of the agreements that you will make as part of that is that you will allow the IRS to review your financial condition every 18 months or thereabouts. And to do that, you won't have to do anything necessarily to the IRS. They will monitor your tax returns as you file them, as you normally would on a yearly basis. And then the automated system at the IRS will be triggered if they see that your income is increased by a certain threshold. But don't be concerned by that. Simply because it's triggered doesn't mean that your payment will automatically adjust. What it will mean is that the IRS will reach out to you and they will ask you to submit a new collection information statement along with supporting financial information just to verify that the current payment agreement, the installment payment agreement that is in place, is still reflective of your financial condition. And if it were to have gotten better for any particular reason, the IRS will adjust it again to right-size it to whatever your new circumstances will allow you to pay. But keep in mind two things. The first is that this is discretionary. The IRS does not have to reach out to you. They just can reach out to you. And the second is that in many cases, the IRS won't go through the trouble, even after collecting additional information from you, of adjusting your installment agreement payment. They're looking for it to move up by a substantial amount before they really do a whole lot to upset what the current arrangement is. So, but that is something that the IRS will do if you have a partial pay installment agreement. And as I mentioned before, the features of a partial pay make it a very good alternative to an offer and compromise, particularly for taxpayers who are income poor but perhaps might be asset rich. So we talked about the installment agreement component, or the option for taxpayers. The other most common option that taxpayers can avail themselves of to deal with a tax balance with the IRS is an offer and compromise. And an offer and compromise is different than an installment agreement because it is very much an offer to settle with the IRS, to settle a tax balance with the IRS for less than the amount owed. That is always the case with an offer and compromise. So whereby with an installment agreement, you might agree to make equal payments or make payments that allow you to pay off the full balance over a set amount of time. An offer and compromise is the exact opposite of that. You're making a settlement offer to the IRS that you pay either with a lump sum or in several payments over a short period of time that settles the tax balance for less than the amount owed. And in many cases, it's far less than the amount owed. It can be 20 or 30 cents on the dollar of the amount owed, depending on the particular offer and compromise. This is an ideal option for taxpayers who have minimal assets available and have very little income relative to the expenses. So, if you have a large tax balance for some reason and you just really aren't making much money, you really don't have a whole lot in the bank, it is a good opportunity for you to reach out to the IRS. You have to demonstrate that you are in those circumstances through the collection information statement that we discussed earlier. But provided you can do that, the IRS will permanently settle your debt and resolve any tax years for which you have balances. As I mentioned before, it's often for far less than the total amount owed. Now, one of the key features of an offer and compromise is that because it's a permanent and final solution for tax balances, there's a very large amount of documentation that the IRS requires before it can be comfortable that the settlement option through an offer and compromise is the best option for both the taxpayer and for the IRS. So not only is there a large amount of documentation required, but there's a fairly pronounced amount of time required for the IRS to review that documentation as well, which means that an offer and compromise often takes a year or more for the IRS to receive, process, and approve. So as I mentioned, due to the permanence of an offer and compromise, these are far harder to get approved than a regular installment agreement. So because of that, as a tax practitioner, I often recommend that taxpayers pursue an offer and compromise as a secondary option to an installment agreement, which means, if you can do a partial pay installment agreement. So maybe you can't quite get where you need to be to qualify for a full offer and compromise. Maybe an installment agreement that's a partial pay makes more sense than an offer and compromise. The other thing that an offer and compromise does is it will stop that collection statute from elapsing. So what that means is if you have a low chance of success when you submit your offer in compromise, it's not worth sending it in, because all it will do is add time, often years, onto the back end of the time the IRS has to collect your tax balance. So an offer in compromise can be a great tool, but it must be thought through in consultation with a tax professional to determine if it really is right for you as a taxpayer. Because if it has a low probability of acceptance, it may not be worth doing. So there are three main types of offer in compromise, and they're distinguishable by how you approach the tax balances, the tax liabilities that you have with the IRS. The first type is called a doubt as to collectability offer, or a DATC. This type of an offer in compromise is predicated on the idea that the taxpayer simply does not have the assets or the income to allow the IRS to collect the tax balances that are outstanding for that taxpayer prior to the expiration of the 10-year collection period. So you're saying, I recognize that there are tax balances and the tax balances are correct, but as a taxpayer, I simply don't have the means to be able to pay those tax balances by the end of the tax cycle or the 10-year tax period. If you say that and you can back it up with financial information, then the IRS will often settle those balances for less than what the balances are. The second type is a doubt as to liability offer. This particular type of offer in compromise is characterized as an offer where the taxpayer is disputing that they are liable for the tax balances that have been posted against their account. This happens oftentimes because maybe they've received bad advice from a third party. That's less common. More common, there is some sort of an issue with advice or guidance provided by the IRS that cause the returns that were filed by the taxpayer to be incorrect and to generate a balance. It's very similar to an audit reconsideration in the mechanisms that are used by the IRS for a doubt as a liability offer. And like a doubt as collectability offer, the taxpayer has to provide collection information, and it has to provide a documentation that plausibly shows or demonstrates to the IRS that the tax balances generated were not actually owed by the taxpayer. And then the final type we will talk about is, I believe it might actually be another one on here too, but the final is the effective tax administration offer. This has to do with settling a tax balance with the IRS or through an offer in compromise, even when the taxpayer has assets and income on hand that would allow them to fully pay the amount owed. And you would do this when there is some sort of economic hardship or paying the balance would be inequitable for a taxpayer. So, for instance, if you are a taxpayer and you're in retirement and, perhaps you have $100,000 in your retirement accounts, but you are retired and you're in poor health, which means you're not able to work, and your tax balance is $90,000. Well, we know based on those facts that you could liquidate your retirement account and fully pay that tax balance. But we also know that since you're in failing health and you're in retirement, that if you did that, you would have no money left over to cover your future medical expenses or living expenses. Well, in that particular case, that would create an economic hardship if the IRS were to require you to do that. So under those circumstances, the IRS will compromise the balance so that it still receives some form of payment for the $90,000 that's owed, but it doesn't put you in a position where you can't afford to support yourself into the future. These are more difficult to get. So, again, you have to be able to demonstrate that there's some form of economic hardship other than it's just not easy or convenient for you to make those payments or to settle the balance for a higher amount. But provided you can do that, an ETA offer can be a good solution for you. So we talked about all these types of these offers in compromise. Economic hardship is a consideration when determining when to make an offer in compromise and what the IRS might accept, along with necessary household and living expenses. Public policy can be an important component of offers in compromise. And the overarching theme here is that an offer in compromise is a option for taxpayers who, have the inability to make payments on a routine or appropriate basis. They might suffer some hardship, or they have tax balances as a result of good faith efforts that they've made based on bad information from the IRS or some other party. Then we do have a fourth here. The fourth one is doubted collectability of special circumstances. So this is really a subsection of the doubted collectability that we talked about at the beginning of this particular section. This has to do with taxpayers who have a doubt as to collectability, specifically with regard to some circumstance that's impacting the taxpayer's ability to earn income due to things like medical expenses or hardship because of family members or things of that nature. So it creates extenuating circumstances, or it addresses extenuating circumstances that further impact the taxpayer's ability to settle the debt. So this is kind of a subset of the doubted collectability. It is something that's often claimed simultaneous to that particular type of offer in compromise. So the last component that we wanted to talk about as part of this webinar is currently uncollectible status. So this fits nicely in with the installment agreement and the offer in compromise collection alternatives, because it evaluates a taxpayer as they are currently, their financial health as it currently exists today, to determine if their income exceeds, or their expenses exceed their income, rendering them unable to either make a lump sum payment as part of an offer in compromise, or to make a monthly payment as part of an installment agreement. If this occurs, the IRS will place the taxpayer's tax balances into forbearance, meaning that they won't take active collection activities against the taxpayers. So there will be no more notices issued, no more phone calls. None of that will happen. The collection statute will continue to run, so it will continue to move closer to that 10-year deadline when the IRS can no longer collect the tax balance. But in exchange for that, the penalties and interest owed on those tax balances will continue to accrue. So this can be a very nice alternative to a taxpayer who really finds themselves in bad financial condition, where they have no ability to pay, they have no assets that they can liquidate to make a payment, but they expect that their financial condition may improve in the future. Like an installment agreement, a partial pay installment agreement, the IRS will revisit currently uncollectible status every 3 years or so, based upon tax returns that are filed, and may update the collectible status of the taxpayer to place them back into collections if their circumstances were to change. I'll move forward a little bit more, please. Okay, so I believe that's the end of our presentation for today. As I mentioned, there are certainly options for taxpayers to address their balances. The most important thing you can do is to take your balances seriously.
Joe, thanks very much. I'm going to jump back in at this time and just remind everybody that you have the ability to ask a question simply by accessing your GoToWebinar questions window. So if you would like to do that now, please do so. And what we'll do is take our first question and see how it goes from there. So the first question I have for you, Joe, is what's the first thing I should do if I get a call or notice from the IRS?
That's a great question. The first thing that you should do if that occurs is, as I mentioned during the webinar, it's to start to assess exactly what the IRS is trying to communicate to you. So, take the phone calls that you get, even if they're scary in nature. Ask good questions. Open your mail. And most importantly, if you feel confused or you're not sure what's going on with your tax balances, it's important to call and consult with a tax professional. Because even in a consultation setting, a tax professional can often steer you in the right direction in terms of what you need to be thinking about and or doing to respond appropriately to the IRS. And as I mentioned, depending on where you fall in the cycle, and you may not know, depending on, what the IRS has been communicating to you thus far, you may have important deadlines that you need to address that if you miss them would allow the IRS to start seizing assets or placing liens on property or what have you. So the very first thing that you should do is get a good sense of what the IRS is asking of you and to respond appropriately as soon as you can.
Great, thanks for that. Okay, I see 2 more questions. So again, last reminder to please go ahead and enter your questions in the queue, and we'll try to get to those. The second question I see here is, what causes a typical offering compromise to fall apart with the IRS?
This is also a good question. So this is the same answer for both offers and compromise and installment agreements. If you work out a collection resolution with the IRS and an agreement is in place to allow you to either make a payment to satisfy your debt through an offer and compromise, or to make monthly payments towards the satisfying of the tax balance through an installment agreement, if you post a new balance or you fail to file a tax return on time, those are the 2 things that will cause you to immediately default on whatever agreement that you've established with the IRS. The third is if you have an installment agreement and you fail to make your payment for more than 1 month, the IRS will typically give you a grace period, but if you go several months without making a payment and you do not call the IRS to let them know that you're not just blowing them off, they will also place your installment agreement into default. If that happens for either an offer and compromise or an installment agreement, you will have to start from scratch and go all the way back to the beginning to re-contact the IRS and negotiate a new settlement. And the second time you do it, so all of these collection alternatives that the IRS provides to you are not required. They are discretionary on the part of the IRS. So that's important to keep in mind, because if the IRS feels like you are willfully violating the terms of either your offer and compromise or your installment agreement, they're not required to allow you to establish a second one. So to recap, if you have an installment agreement or an offer and compromise, it's important to continue to file your returns on time and make any payments of tax that are owed or that are due with those tax returns at the time that it's due. And in the case of an installment agreement, to make sure you make your payments on time.
Excellent. Okay, we've got one last question. I don't see any others coming in, so this one is probably generated by the headlines in the news these days. But the question is, what should we expect from the IRS under the new administration in Washington, D.C.?
Well, this is sort of the topic of the hour at the moment. There is quite a bit of turmoil at the IRS. Recently, the service had a drawdown in its workforce of up to a third of its total employees. And this is going to impact things quite a bit in terms of, the ability of the IRS to respond to new tax returns that are filed, or for taxpayers to be able to contact the IRS to work through some of these collection alternatives that we've talked about. For new taxpayers who have balances, the most important thing to do is to kind of get out in front of things. It's to address things, not assume that they have, unlimited amounts of time to contact the IRS, but to be much more aggressive in terms of calling the IRS to talk through balances and to make arrangements to address those balances. Practically speaking, from a tax perspective, until we get news that there are changes with regard to tax law, whether it be income tax rates or filing deadlines or what have you, taxpayers should be prepared to proceed as though it is business as usual at the IRS. But having said all that, it's also important that taxpayers stay up to date and current on new developments with the IRS and the tax code. And to do that, you can reference or rely on the tax blog posts that we publish here at Plunkett Cooney on our Legacy Law blog.
Great. I love it when you start promoting. This is good stuff. Thanks, Joe. This has been really helpful information, just a ton of good information. And I hope everybody enjoyed today's program. Let me just take a couple of minutes to talk about a couple of things here, and we'll get you get you off the line. So before we end today, you're going to be asked to answer a quick pop-up survey from us. We hope that you will just take a couple minutes to do that. It's very quick. We always love to receive the information and feedback that you provide, especially any topics you'd like to see us address in the future. In case you or a colleague would like to see the recording of this program, it'll be on our website, hopefully a little later today on plunkettcooney.com. Go to the Insights tab, and you can go down to our events and find it there. And the recording will be available, like I said, hopefully later today, tomorrow at the latest. And the other thing, Joe, you kind of got ahead of me a little bit, but I don't mind. Another promotion of our Legacy Law blog. We have that program as part of our Legacy Law Practice Group, which also includes trust and estate planning and probate matters. Joe's part of that group, providing some tax background there, and so we call it our Legacy Law blog. We'd like you to check it out. All the latest and greatest updates are put there in real time, so you can find those. I do want to mention that we have our next couple of installments coming up. The next will be in July, part 2. I think, Joe, we committed to doing it in July. And then the third installment will be in September. So be on the lookout for further event invitations from us. We'll get those to you in your inbox. And we hope you can join us for those. We'll go through more of this information that Joe started with the offers and compromise and other collection alternatives of the IRS, and then ultimately, I think we're talking about some audit stuff at the end. So, a lot of good information coming your way, and we hope you can join us. So, with that, I'm going to thank everybody for coming on behalf of Joe, myself, everybody in the tax law and legacy law practice groups here at Plunkett Cooney. We thank you, and we hope you will have a great rest of the day, and we'll see you next time.